You're listening to The Deep Dive. Today we're jumping into something huge in finance. You know how trading used to be, people shouting on floors. Well, now it's mostly computers. We've got this great resource, a Go comprehensive report, automatic trading versus manual trading. And our mission really is to pull out the key stuff, the good, the bad, of both ways of trading. We want to give you a clear picture of how things are changing. So whether you're just curious about how markets tick or maybe thinking about trading yourself, or maybe you just want to understand this, big tech shift in finance, this deep dive is for you. We'll break it down simply.
Yeah, it's a really fundamental change, and understanding both sides, manual and automatic, while it's crucial for grasping modern markets, this report gives us a really good way to look at it.
Okay, great. So let's dive right in. Manual versus automatic. What's the basic difference? Let's start with the traditional way. Manual.
Okay, so manual trading is essentially driven by a person, a human, doing the analysis, making the calls. Picture someone looking at charts, reading the news, maybe checking company reports, and then using their own judgment, their intuition, to hit buy or sell. They use tools, obviously, like charts and indicators, but ultimately, the human makes the final decision. The report gives a good example. A day trader sees a pattern, maybe on USD, thinks it looks bullish, and they manually place that buy order themselves. It's very hands-on. Based on experience, maybe a feel for the market.
Right. Makes sense. The person is right there making the judgment call. So how does automatic trading, or I guess algorithmic trading, how does that differ?
Well, automatic trading is basically the opposite. Computer programs, algorithms, they execute the trades. They follow a preset list of rules or instructions. And these rules, as the report points out, they can come from technical signals, like moving averages crossing, or finding tiny price differences arbitrage, or even complex statistical models looking for patterns. The example in the report is a hedge fund algorithm spotting a tiny, super brief price gap between an ETF and its underlying stocks. The algorithm just jumps on it, places the trades automatically to capture that tiny profit. We're talking milliseconds.
Wow, milliseconds. Yeah, that highlights the speed difference straight away.
Right.
Okay, so let's unpack the advantages. What does each method really offer? What are the main upsides of sticking with manual trading?
Well, the report points out a few key strengths. First off, human judgment. Think about unexpected news hitting the market, a sudden political event, a natural disaster, or just sheer panic selling that doesn't fit any historical model. A human trader can look at that, understand the context, react flexibly in a way an algorithm, bound by its code, just can't. You can't easily program for every possible weird thing that might happen, right?
Exactly. You can't code for those unknown unknowns.
Mm.
So that human intuition, reading the room, as you say, that's really valuable. What else is good about the manual approach?
Another big one is discretionary adaptation. A human can just decide, okay, stop. They can pause trading if things feel too chaotic or if something big is happening in the world that their strategy isn't built for. They can override the plan based on what's actually happening right now. And, beyond just hitting pause, they can step back, rethink the whole strategy if the world changes.
So it's having that control, that ability to say, hold on, this feels wrong, and change direction based on new, maybe unquantifiable information. The report also mentioned a personalized learning curve. What's that about?
Right. With manual trading, you learn by doing, basically. It's very direct. Traders learn from every trade, every win, every loss, every market cycle. And that experience, over time, it really refines their decision-making. They develop a sort of instinct, a feel for the market. It's like, learning to ride a bike by actually falling off a few times, not just reading about it. You get this practical know-how.
Yeah, that gut feeling, that experience.
Yeah.
Makes sense. Okay, let's flip it. What about the advantages of automatic trading? Speed seems like the big one.
Oh, absolutely. The report hammers home speed. Algorithms trade in microseconds, millionths of a second. It's just a different league compared to human reaction time. Like the report says with high-frequency trading, HFT firms, speed is everything for them. They're making maybe millions of trades a day, profiting from tiny, tiny price differences. No human could possibly do that. It's not even comparable, really.
Operating on a completely different timescale.
Got it.
What's another key plus for automatic trading?
Emotionless execution. That's huge. Algorithms just follow the rules. They don't feel fear or greed or hesitation or panic. All those things that can mess up a human trader's decisions. Fear of missing out, holding winners too long, selling losers too late. The algorithm just sticks to the script. It's kind of interesting trying to engineer emotion out of trading.
Yeah, I can see how that would prevent a lot of impulsive mistakes. What else does automation bring to the table?
Back testing. This is really valuable according to the report. Before you risk real money, you can run your algorithm strategy on historical market data. Years of it. See how it would have performed in the past? This lets you tweak it, optimize it, find weaknesses. It's sort of like a flight simulator, but for your trading strategy. Practice without the real crash and burn risk initially.
Right, so you test it against history before you let it loose. Smart.
Okay.
And I assume these things can just keep going all the time.
Yeah. Exactly. 204/7 operation, that's another plus. Algorithms can watch multiple markets, different time zones, constantly scanning for opportunities, even when you're asleep. And for big institutions, scalability is massive. They can run tons of different strategies across loads of different assets all at once using automated systems. Imagine trying to manage, say, 500 strategies manually across the global markets. Just impossible.
Yeah, no way you could juggle all that by hand.
Mm.
Okay, so we've seen the good sides. Now for the challenges, the downsides. What are the drawbacks of relying purely on humans for manual trading?
Well, that same human judgment, that's an advantage. It can be a weakness, too. The report flags emotion-based decisions as a major problem. FOMO, fear of missing out, makes you chase prices up. Panic makes you sell at the bottom. Getting overconfident after a few wins can lead to taking way too much risk. We all know how emotions affect decisions, right?
Absolutely. That emotional roller coaster is definitely a thing. What else makes manual trading tough?
It's also just incredibly time-intensive. Being a good manual trader often means being glued to the screen. You have to constantly watch charts, read news, analyze. It's a full-time commitment, usually, not really a casual thing. And naturally, there's a limited market reach. One person can only really track so much at once, maybe a handful of markets or stocks effectively. Trying to follow dozens, your attention just gets spread too thin.
Makes sense. You can't watch everything. And the report also noted slower reaction time for manual.
Precisely. By the time a human spots an opportunity, thinks about it, then physically enters the order. Especially in fast markets, the best price might already be gone. Those few seconds, even fractions of a second, can matter a lot. You miss the boat.
Ready. So manual has its hurdles. What about automatic trading? All that speed and efficiency must come with some risks, right?
Oh, definitely. A big one mentioned is overfitting and backtesting. As the report explains, you can design an algorithm that looks amazing on past data, perfect performance historically. But sometimes that just means it's too perfectly tuned to those specific past conditions. When it hits the live market, which is always changing, it might fall apart because it wasn't robust enough. So, great historical results don't always guarantee future success.
Ah, so it looks good on paper based on the past, but fails in the real messy present. Okay. What's another potential issue with automated systems?
Technical failures. That's a constant worry. Like any tech, these systems can break, internet goes down, there's a bug in the code, the data feed has an error. Any of those glitches can cause huge, very fast losses if trades go wrong or don't happen when they should. It's a background hum of anxiety for people running these things.
Yeah, you're totally dependent on the technology working perfectly. What about the algorithm's grasp of the bigger picture? What's happening outside the market data?
That leads to market unawareness. An algorithm just follows its rules. It might keep trading normally, maybe even inappropriately during some huge unforeseen event, a sudden geopolitical crisis, a major economic shock. It doesn't have that human ability to go, whoa, something fundamental just changed. Maybe I should stop.
Yeah.
It can be blindly executing orders when the whole context has shifted underneath it.
Right. No common sense to read the global news, basically. The report also brings up black box risk. Sounds kind of ominous.
It can be, yeah. Especially with complex AI and machine learning models. Sometimes these algorithms become so intricate that even the people who built them don't fully understand why they make every single trade. This lack of transparency makes it really hard to figure out what's wrong if the algorithm starts behaving strangely. It's a bit like trusting an autopilot you don't completely understand.
That does sound a bit unnerving. Now, the report talks about how much algorithmic trading has grown. Can you give us a sense of the scale?
Yeah, the numbers are pretty staggering, actually. In the U.S. stock market, the report says something like 70 to 80% of the trading volume is now automated.
70 to 80%. Wow.
Yeah, it's the dominant force. And in the Forex market, it's estimated around 60-65% algorithmic. And what's also interesting is the explosive growth in places like India, Brazil, South Korea. Regulations are supporting it. Markets are going digital. It's a global trend.
That's incredible. So computers are really running the show in many ways. What's driven this huge shift? What are the key drivers?
Well, the report points to a few main things. First, just improved infrastructure. faster internet, these super low latency networks that cut delays down to almost nothing. The
Yeah.
co-location, putting your servers right next to the exchange's servers, that shaves off critical milliseconds. It makes high-speed trading feasible.
So the plumbing got way better.
Exactly. Second, AI and machine learning. Huge impact. Algorithms that can actually learn from data, adapt their strategies, maybe even read news sentiment. That's a game changer. They can process way more information than humans ever could.
And
Finally, retail access. It's not just the big guys anymore. Platforms like MetaTrader, NinjaTrader, QuantConnect, they give individual traders the tools to build and run their own automated strategies. It's become much more accessible.
so individuals can play in this space now too.
Yeah.
Okay, with this massive move to automation, it must be affecting the markets themselves, right? The report mentions positives and negatives. Let's start with the good impacts.
Yeah, a key positive is increased liquidity. More players, especially algorithms constantly placing buy and sell orders, generally means it's easier to trade. It leads to tighter bid-ask spreads, that gap between buying and selling prices. Smaller spreads mean lower transaction costs for everyone, basically.
Okay, so it makes trading generally smoother and cheaper. What else?
Efficiency. Algorithms are super quick at spotting and closing arbitrage gaps. Those tiny price discrepancies for the same thing in different places. Algorithms zap those almost instantly, which helps keep prices more consistent across the board, making the market more efficient overall. And partly because of all this, we've seen lower costs, generally commissions, fees, that kind of thing have come down due to automation and competition.
So generally, more accessible, efficient, and cheaper markets. Sounds good.
Yeah.
But the report also warns about negative impacts. And flash crashes definitely sounds bad.
Yeah, that's the big scary one, flash crashes. These are those sudden, terrifyingly sharp price drops that happen in minutes or even seconds, often followed by a quick rebound. The report highlights the famous one, May 6, 2010. The Dow dropped like 1,000 points in minutes.
I remember that. Chaos.
Exactly. It showed how algorithmic errors or just weird interactions between different algorithms can cause extreme volatility. Systemic risk. When things go wrong with algos, given their speed, they can go wrong very fast and have huge consequences.
That is incredibly sobering.
Yeah.
A drop like that shows the potential for automated systems to just malfunction spectacularly. What other downsides?
Well, there's the issue of unfair advantage, particularly for HFT firms. They spend fortunes on that ultra-fast tech, the co-location we mentioned, giving them a speed edge measured in milliseconds. It raises questions about whether it's creating a two-tiered market, the super fast versus everyone else.
A technological arms race, essentially.
Pretty much. Then there's market manipulation. The report notes that things like spoofing, placing fake orders to trick others can be done much more easily and rapidly by algorithms. Makes it harder for regulators to catch.
And jobs.
Yeah, job displacement. More automation means fewer roles for traditional floor traders, some types of portfolio managers. Their tasks get taken over, or partly taken over, by the algorithms. It's the classic tech disruption story.
It really is a complex mix. Benefits and serious risks. The report mentions firms like Renaissance Technologies, Two Sigma, using really advanced AI. It's hard to even imagine algorithms processing that much data that quickly.
It really is mind-bending. We're talking AI models that can digest news sentiment from articles using NLP, analyze earnings call transcripts, find incredibly subtle patterns in mountains of price data, economic reports, all in real time. No human team could possibly keep up.
And again, the report brings up the 2010 flash crash as that stark reminder of what can happen when these powerful systems hit bumps in the road. So looking forward, based on this report, what's the future likely to look like?
The report suggests a few key trends. One is hybrid trading models. This seems increasingly important, combining human oversight and strategic thinking with the speed and efficiency of algorithms. So maybe humans focus on the big picture, risk management, handling really weird events, while algorithms do the heavy lifting of execution.
Makes sense. Best of both worlds.
Potentially. Also, deeper integration of AI and NLP, algorithms getting even better at understanding unstructured stuff like news, social media, and crucially, regulatory advances. Regulators need to keep up. That probably means better monitoring tools, maybe new rules around certain high-speed strategies to reduce those systemic risks we talked about.
Right, so a future of human-machine collaboration, hopefully with strong guardrails from regulators. Okay, let's try and wrap this up. What are the main takeaways from this deep dive? And what advice, maybe, for the learner listening in?
I think the core message is that neither way is perfect. Both manual and automatic trading have clear strengths and weaknesses. Manual gives you that crucial flexibility, that human touch for certain situations or strategies. Automatic gives you speed, consistency, scalability, but it also brings risks, big ones like market instability. So, this idea of a hybrid model, blending the two thoughtfully, that seems like a really promising direction for many people.
And for you, our listener, if you're new to all this, the report suggests really starting with the basics. Understand how markets work, maybe through some manual practice, build that foundation. If you're thinking about automation, go carefully.
Hmm.
Use good platforms. Test things thoroughly with historical data. First, that back testing we mentioned. But really, for anyone interested in finance today, just understanding this technology, how it works and how it impacts the markets, that's becoming essential knowledge.
Absolutely. Whether you trade yourself or you're just trying to understand the financial world, getting a handle on this human-machine interplay in the markets is, well, it's pretty key now.
Well, that about does it for this deep dive. We've taken a close look at manual versus automatic trading using insights from that old comprehensive report.
And maybe a final thought to leave folks with. As these algorithms get smarter, more integrated, what new ethical questions, what economic challenges are going to pop up? What do we as informed people need to start thinking about? It's definitely something to ponder.
That's a great question. Thanks so much for tuning in to this deep dive. We hope you'll keep exploring this topic and thinking about how these powerful trends are shaping finance and your own understanding of it all.